You can follow every traditional financial rule and still find yourself trapped in a cycle of staying exactly where you are. You might cut your expenses, start your 401k early, and put in 60-hour weeks, yet the needle on your net worth remains frozen. Think about the trajectory of those who move from entry-level labor, scrubbing floors as a maintenance worker, to eventually overseeing massive portfolios at a firm like Goldman Sachs. That kind of journey reveals a hard truth. Money doesn't care about good intentions. It functions according to fundamental rules that most people never learn. Therefore, I want to break down the 7 rules that govern how capital truly operates in the modern world. But before we get to the laws, we need a foundation. Think of this as a 3-part framework: momentum, structure, and asymmetry. These are the 3 pillars that support every law we are about to discuss. Momentum is about the mechanics that let your money snowball. Structure is about who actually controls the money. And asymmetry is about making sure you can win big while only risking a little. Law number 1. Money craves velocity, but wealth craves duration. Now, I want you to really think about this first law. It's the reason why your hardworking neighbor might still be struggling, while that quiet person down the street just bought their second apartment complex. Law number 1, money loves speed, but wealth loves time. In the property market, many people start as aggressive flippers. They find a house, renovate it, and sell it immediately to get their cash back. For 5 straight years, a flipper might constantly rotate their capital, thinking they are winning because they are moving fast. But look at the other side of the coin. During that same 5-year window, consider an investor who took a different path. He began with a modest single-family rental. A few years later, he moved into a small multi-unit apartment building. He remained patient for several more years. Eventually, he refinanced that equity and acquired a substantial 20-unit residential complex. The flipper processed 100 houses and made a lot of active income, but he also paid a massive price. Every time the flipper sold, he lost 6% to commissions, another 30% to short-term taxes, and thousands in closing costs. The investor, however, kept his capital working. By the end of those 5 years, the investor's total value was 5 times higher. He didn't work harder, he simply let his assets breathe. When we say money loves speed, we mean the time it takes between seeing an opportunity and taking action. The more we can shorten this delay, the faster capital circulates. Conversely, what does wealth loves time actually imply? It means making a singular high-quality choice and staying put over a long horizon. The frustrating part is that, in the beginning, this strategy looks boring. You might not see any visible progress at all. However, as the decades stack up, the snowball effect of that initial decision becomes undeniable. It's a common trap to think that moving fast always means getting results fast. The goal is to master both the entry speed and the holding time. Warren Buffett's career is the ultimate masterclass in permanent ownership. He bought great companies and simply refused to sell. Between 1965 and 2024, Berkshire's value grew at a compounded rate of nearly 20% every year. That is double the speed of the rest of the market. Their total gain eventually reached a staggering 5 million%. Always keep in mind, speed is closing the gap between an idea and doing it. Time is the discipline of trusting a smart decision and letting it grow. There is a vital truth behind this. Your most powerful ally in the pursuit of fortune is the calendar. Once you realize that time builds the mountain, you have to ask, who is actually standing at the top? Because in the theater of finance, the party providing the cash is the one who writes the script. Law number 2, the provider of capital dictates the terms. This leads us to law number 2, he who gives the money has the power. In the world of business, the people who build a company from scratch often make good money, but the people who buy and combine those companies make a fortune. This is because acquirers have a structural advantage. If you look at the Forbes 400 list, you will find 3 categories of titans. First, there are those with a high salary. Second, there are those who sold a single business. Third, there are the buyers and builders, those who constantly buy and connect new assets. Let's look at the data. Currently, there are 0 people on that list who got there through a salary alone. What about the founders who sold? There are a few notable names like Mark Lohr, who sold Jetcom to Walmart. But the buyer and builder style is what dominates the list. Consider Elon Musk, Jeff Bezos, or Warren Buffett. These figures are constantly absorbing and expanding opportunities. The one who provides the capital is the one who owns the future. When Meta acquired Instagram for $1 billion, many scoffed. Today, that asset is worth more than $45 billion. Google's purchase of YouTube for $1. $65 billion secured their dominance. We see this even more clearly in professional sports. Henry Samueli invested $70 million into the Anaheim Ducks in 2005. Today, that franchise is worth over $16 billion. Mark Cuban bought the Dallas Mavericks for $285 million and sold his majority stake for $3.5 billion. No matter how you look at the numbers, the buyers hold the leverage because they set the conditions. This is the model used by top-tier acquisition firms. They operate a flywheel where they use their reputation to attract high-potential firms, then use their resources to expand them for the long haul. Now, when you hear the phrase buy and build, you might think, I don't have the money to purchase corporations. How does this apply to me? You don't need $1 billion to adopt the mindset. It simply requires you to understand how the game is played. Massive fortunes are built through the acquisition and improvement of assets. Once you position yourself as the one putting resources to work, you'll notice a shift. The most successful people aren't working harder. They are using more powerful tools. And the most powerful tool in the toolkit is leverage. Law number 3. Leverage is a force multiplier. Next is law number 3. Leverage multiplies everything. I'll give you 4 distinct scenarios where leverage changes the math of our lives. Imagine you buy a house for $1 million in cash, and over 3 years it goes up 10% to $1 million. You earned a 10% return. That's okay. But what if you got a loan for $800,000 and only put $200,000 of your own money down? If that same house grows by 10%, your profit is still $100,000. But that now represents a 50% return on your actual cash. This jump is only possible through leverage. It turns a small move into a massive one. Leverage actually created an entire global sector known as private equity. These are professionals who buy everyday businesses, like a local car wash or a restaurant, and use bank financing to scale them rapidly. This multi-trillion-dollar market would vanish without leverage. This principle is just as powerful in the world of commercial real estate. When you buy a 20-unit apartment complex, the game changes. First, you typically only need to put down about 30%. Second, because the building makes money, the loan is often secured by the property itself. But most importantly, the government gives you huge tax breaks for these deals. Leverage doesn't just increase your buying power, it gives you a shield against taxes. However, there is a secret strategy the ultra-wealthy use that most people miss. Here is how the world's richest use leverage to avoid tax bills. Think about Elon Musk again. When he bought Twitter, he didn't just sell off his Tesla shares. Doing that would have created a massive tax bill. Instead, he took out loans using his Tesla shares as collateral. The banks were happy to lend because they could just take the stock if he didn't pay. This allowed him to access billions in cash to buy Twitter without selling a single share. He kept his ownership and skipped the tax bill at the same time. Many people are afraid of debt, but there is a big difference between bad debt and strategic leverage. Here are 4 ways to view this tool. 1. Recognize that leverage is the engine of the economy. 2. Study the specific risks. 3. Remember that leverage is always about what you put up as a guarantee. 4. Since taxes are the biggest hurdle to wealth, remember that a loan is an income. You don't pay taxes on a loan, which gives you a massive head start. Law number 4. Cash flow is survival, equity is freedom. Leverage is not a magic wand on its own. It only makes what you already have bigger. This is why you must know the difference between your monthly income and your ownership. Law number 4. Cash flow keeps you alive and equity makes you free. Cash flow is what pays for your life right now, the mortgage, the groceries, and the travel, but equity is what owns your future. You might ask, what is the best way to hold equity? The top method is to own your own business, but the silver medal is owning a piece of someone else's success. Think about it. There are thousands of world-class companies you can buy a piece of right now, like Amazon or Google. Your goal is to use your current cash flow to buy equity in someone else's wealth machine. At the end of the day, you must either own your own engine or own a part of someone else's. Equity is the only thing that buys your time back. Consider the McDonald's business model. Most people think they sell burgers, but the reality is far different. Their restaurants make cash, but the real wealth is in two other areas. $16 billion in royalty payments and a massive $45 billion real estate portfolio. The cash from the burgers makes them rich today, but the ownership of the land makes them wealthy forever. Law number 5. Risk and reward are nonlinear. This is where smart professionals often get stuck. They look for safe, 5% returns and mistake it for wealth creation. Real wealth appears when you realize that risk and reward do not move in a straight line. Law number 5. Risk and reward are not a one-to-one trade-off. Look at the venture capital world. Suppose a firm makes 5 separate $100,000 investments. Their total potential loss is locked at $500,000. Now let's say the first 2 bets fail. The third one just breaks even. The fourth one returns 10x the investment. The fifth one becomes a unicorn and returns 100x. Those last 2 wins don't just cover the losses, they create a fortune. The goal is to play a game where your loss is limited, but your gain is unlimited. Our mission is to expand the upside while putting a hard floor on the downside. The point isn't to win every time, it's to stay in the game long enough for the math to work. Law number 6. Never risk the kingdom for a sack of gold. This brings us to law number 6. Don't bet the empire for a pot of gold. There's a story of someone who gambled 15 years of work on a single transaction and lost everything. A couple had saved over $700,000. They were pitched an investment in oil and gas that seemed perfect. It had tax breaks and huge promised returns. They moved their entire life savings into that one project. Within 24 months, the money was gone. 15 years of labor evaporated in an instant. The takeaway here isn't that oil is bad. It's about position sizing. You do not put the entire kingdom at risk for a chance at a bigger treasury. If you have built something substantial, your primary job is to make sure that no single failure can take you down. Masters focus on removing the risk while keeping the reward. There are 2 rules to this. 1. Protect the engine that makes your money, that is your empire. 2. Only swing for the fences when your potential loss is strictly limited. Once you are safe, you only lose money where you are being ignorant. Law number 7. Diversification is a shield against ignorance. The financial industry tells you to spread your money everywhere. But every truly wealthy individual does the exact opposite. Why? Because when you don't understand a business, you are just gambling. Here is a simple way to look at it. When you deeply understand the risk and you have control, you should concentrate your capital. You put your eggs in one basket because you are the one holding the basket. But if you don't understand the risk or have control, that is the only time you should fully diversify. That is when you spread your bets wide to protect yourself from what you don't know. This is why titans like Bill Gates or Elon Musk keep their net worth tied up in their own companies. They have the data, the plans, and the power to change the outcome. To them, diversifying would actually be more risky. Understanding these 7 laws is the first step, but the real power comes from applying them together. Before you spend a single dollar, ask yourself these 5 questions. 1. Can this grow for a long time? 2. Who is in control? 3. If this fails, what is the backup plan? 4. Is the profit much bigger than the risk? And 5. Can I explain this to a child? If you can't describe how the money is made and how it could be lost, you don't understand it yet. Now that you know the laws, you need to see how to use them when the choice isn't obvious. Check out the next video, where I'll walk you through the decision-making matrix I use when the path forward isn't clear.